Hello. So, Repco Home Finance Limited is the company that is being analyzed today. Now, as the name suggests, this is a finance company. It more or less functions as a bank. It gives out loans, especially for homes, building homes, so home loans, and a percentage of its loans it gives out for taking loans against property, where you can take the loan, use it for other purposes, but you will have your home or your property taken as collateral security. So this company is not the biggest of companies. The market cap is around 2,312 crores as of August 21, 2025. The current price of one share is 370. The book value per share is 548. So this company is trading or currently can be bought at or is currently trading at an extremely high discount to book value, at a big discount to book value. The PE ratio is 4.98. The return on equity is 14.4, not the best, not the worst. Return capital employed is 11%, pretty nice. Overall, this video is not financial advice, but return equity, return capital employed, not the worst. Dividend yield of 1.08%. All right, let's look at its long term financials. Now, one thing, even though it's a financial institution, uh, it cannot take loans. It's a home finance company. It cannot take deposits. My fault. Cannot take deposits. So it relies on loans from other banks and other financial institutions to actually provide loans to people. All right. So here we have the financials from 2015 all the way to 2025. 2015, 2025. Here we have revenue, here we have interest, expenses, financing profit, financing margin, which is basically financing profit as a percentage of revenue. Okay, financing margin is financing profit as a percentage of revenue. Here we have profit before tax and profit after tax, or net profit. The revenues were 693 crores in 2025. Here we can see the growth rates also. 882 crores in 2016, 27% growth. 2017 registering massive 18% growth, reaching 1,000 crores in revenue. Then 6% growth, all right, 2018. 2020, 13% growth. 2021, 2% growth. Then came the COVID times, 2022, 2023, 2021, COVID era, you can say. Interesting time though. Minus 6% 2022, all right. Then 2024 rebounds to 19% growth, 1,500, 1,535 crores worth of revenue, and 2025, 1,716 crores worth of revenue. Okay, 11% growth this year. So 1,716 crores worth of revenue and 461 crores worth of what? Pure net profit. That is profit after tax. Now, in terms of percentages, the compounded sales growth over the last 10 years has been 10%. So this company is not a fast grower. Its revenues are not growing really fast. Its profits are growing faster than revenue. Last 10 years, 14%. Even the low of last 5 years and 9%, not the worst. So not the biggest revenue grower and not the biggest profit grower, but trading at a big significant discount to book value, and that's the only positive. Now, the last 5 years, 5% growth is low, mainly, I believe, due to COVID. So profit growth 14, compounded sales growth of 10% over the last 10 years. Moving on, we have the return on equity. Return on equity over the last 10 years has been 15%, last 5 years 13%, and last 3 years 14%. It was reaching highs of 20% at one point in like 2017-ish, 2017, 2018-ish. It was reaching highs. So not the biggest return equity giver and not even near its all-time highs. All right. Now, if you're going to take a look at more of its financials, okay? We took a look at revenue growth, 10%, profit growth, 14% over last 10 years. Okay. And here we add more of its financials and even more information about this company. Okay. Again, this video is not financial advice. Now, first, in the business summary, all right, this is the business summary. Loans outstanding, the total loans outstanding of this company, 146,899 million rupees, which translates to 14,689 crores. Total loans the company has right now given to its customers and all that. Now, the next thing, the net owned funds. This is an important metric. What does it actually mean? Net owned funds, the name suggests this refers to money or capital owned by the fund itself. This is the money it can use without raising any more debt. And it acts as a capital base. You can say the more they have this net owned fund, the more they can actually borrow, and the more they can actually lend out. So it's a base for borrowing, basically. Net owned funds, 34,015 million rupees or 3,400 crore rupees. All right. Capital adequacy ratio, again, a very important metric, 38.69%. Pretty solid, very solid. Average loan per unit of 1.31 million rupees. I don't know how much of that is in crores or lakhs. Number of live accounts, you can see number of customers basically, 1,12,207 people. Employee strengths, 1,500 employees. All right. Now, here we have two data points. We have sanctions and we have disbursements. What is the difference? Okay. Sanctions refers to a total amounts of loans that have been approved on paper. Disbursements is the actual amount of money actually given out, dispersed, given out to the customers or the people taking the loan. Now, here we can see loans have been rising, disbursements have been rising. Uh, what are these numbers in again? These are all in millions, millions of rupees. So disbursements, this data is for quarter one fiscal 2026. Disbursements for the latest quarter one fiscal 2026, 8,289 million rupees. And sanctions will obviously be a bit higher. Comparing this to quarter one last year, here we have quarter one last year directly below me, 6,804 million. So very, very big rise, like around 20% rise in disbursements. All right. Okay, moving on. Here we have some important info. Loan book, the total loan book, we already saw this 14,000 crores, but an increase from 13,701 crores to 14,689 crores, 7% increase, and only 7% increase in loan book. Interesting. The net owned funds have experienced a dramatic increase from 27,709 million rupees, 2,700 crores, to 34,015 million, 3,400 crores worth of net owned funds. Net owned funds. So massive increase in net owned funds, a massive increase in its own capital, in its capital base. Maybe one can say, just assumption, that Repco Home Finance may have a lot of excess capital. Maybe it's not using enough of its capital to give out even more loans and all that. Now, the loan book composition. Okay, 52% of its loans are given to salaried people. Sorry, 52.3% of its loans are given to non-salaried people, and 47.7% of its loans are given to salaried people. Okay, mix of the loan portfolio, 72.4% right now given for home loans, meaning loans given for building a home and or buying a home. I believe, yeah, building or buying a home. Home equity, 27.6% refers to like loan against a property, right? Loans for other purposes, but in a situation where your property acts as collateral security. All right. Now, here we have the profitability metrics. First, the net interest margin. Very important metric for financial institutions. 5.2% stable. Higher the number, the better, but 5.2% stable. All right. Spread. Spread is the difference between the interest rate the company gets on its loans minus the interest rate the company pays on the loans it got from other banks and other financial institutions. 3.3%, 0.1% percentage point decrease. Okay. Return on assets, 2.9%, slipped from 3.1%. Okay. Return on equity declined from 16.3% to 14%. Could be a concern. 14% return on equity from 16.3%. Important. Then here you have the income from operations, again in millions, but 435 crores. All right, all right. Net interest income rose by 9%. Okay, net interest income again. Interest given to the company by loans. The interest it earns on its loans, right? Minus the interest it gives out on the loans, the interest it receives minus interest it pays. Interest it pays on what? Its own borrowings, and interest it receives on what? The loans it gives out. Net profit this quarter, 108 crores. We already saw sanctions and disbursements. Okay, so 5%, 5.2% NIM, return equity is declining, which can be a concern. Here we have the cost to income ratio, which is basically the operating costs of this financial institution of Repco Home Finance Bank upon its total income. Its income, 24.3%, a bit high, bit higher than 23.6% seen from 12 months ago, but okay, 24%, not the worst. Now, asset quality. This is an important metric, okay? In asset quality, we're going to be seeing two things: gross NPAs and net NPAs. Here we can see the lines, all right? Both of them have declined, at least compared to 12 months ago. Gross NPAs have declined from 4.3% to 3.3%, while net NPAs have declined from 1.7% to 1.2%. The lower this number, the better. NPAs are non-performing assets. Basically, the loans which the borrowers are unable to pay back. They're unable to pay back the interest on time. They have defaulted. Okay, this is the movement of gross NPAs. How have the gross NPAs or the non-performing assets, total non-performing assets of this company looked at as a percentage of its total loans? So they peaked around 7% during COVID-19, the second wave. From then on, it has declined and moderated to 3.3%. Before that, before that, you can see 1.3% gross NPAs in 2016. All right. Okay, okay. Then we have the credit cost. Credit cost is has actually gone negative. Now, credit cost, from what I understand, is this. It's a cost, obviously. It's basically the provisions made. The provisions made, I believe, provisions made divided by the total revenue. Total revenue. Credit cost is the provisions or the funds set aside to cover these credit losses, these loans going bad, these loans on which consumers are what? They're defaulting. Customers are defaulting. So they make funds, they make provisions, they set aside money to cover these bad loans, all right? That as a percentage of the income, all right, has declined and it's actually negative. Why is it negative? Because it's recoveries from loans. Like, because even though loans are becoming bad, what do they have? They have the home as collateral security. So they can still take the home of the person who defaulted on the loan and then sell it to the market and then recover their money back. That's why the credit costs have gone negative, because the recoveries have been more than the losses. Then, finally, we move to this. Who is the company actually borrowing from? Where is it getting its money from? This is its borrowing profile. Okay, it seems majority of its loans, 82% are from commercial banks. 1% is from commercial papers, short term, short term loan instruments, commercial papers are. 8% from its promoter bank, Repco Bank. So its promoter bank, owning around 30% of the total shares, is Repco Bank, and 8% is given by the National Housing Bank. Then, moving on, we have its geographical presence. This is a highly concentrated bank, highly concentrated. Here you see the total number of branches and branch concentration. The branch network you can see increased from 193 2 years back to 223 branches 1 year back. Now 234 branches in total. Okay, 234 branches. and extremely concentrated in one place only. That is Tamil Nadu. Big concentration in Tamil Nadu. This is loans by region. Here you can see 57% of loans are from Tamil Nadu. Yeah. But this is a declining percentage. It's trying to diversify from Tamil Nadu. Then we have Karnataka 13%, Maharashtra 10%. That's nice, Maharashtra 10%. Andhra Pradesh 6%, Telangana 5%, then and so on and so on. Gujarat small 3%. All right. I think that's it. Yes, so extremely concentrated bank. Recently, the loans it gave out, total number increased by a lot. Credit cost became negative, decent return equity, decent return on capital employed. I mean, among its peers, it's pretty average to pretty good and not a fast grower. Not a fast grower. Trading at a discount to book value. Again, the growth is pretty small. Its latest numbers haven't been the best. The revenue grew by only 6.7%. You can see 436 crores, only 6.7% growth in overall revenue. Profit growth of only 2%. That's because of higher tax expenses, higher tax expense for this quarter. But the financing margin, which is shown here, is still a higher 34%, 36%. So still a stable financing margin, financial operating margin of 34, 36%. Moreover, a slow grower, but financially stable.